Warren Buffett, the renowned investor, is known for his insightful market analysis. Often referred to as the Oracle of Omaha, Buffett has a track record of making astute observations about the financial markets. His words carry significant weight, influencing both individual investors and large financial institutions alike. Recently, he expressed concerns about the market being overpriced. Buffett pointed out that the current valuations of many stocks are not supported by their underlying fundamentals. This has led to a growing unease among market participants who respect his judgment. His warnings have caused investors to take notice. Many are now reevaluating their portfolios, considering whether they have overextended themselves in an overheated market. The ripple effect of Buffett's cautionary statements can be seen in the increased volatility and trading volumes. Buffett's cautious stance stems from his deep understanding of market cycles. He has always emphasized the importance of value investing and the dangers of speculative bubbles. His approach is grounded in a long-term perspective, focusing on sustainable growth rather than short-term gains. He has witnessed periods of irrational exuberance followed by painful corrections. Buffett's experience during past market crashes such as the dot-com bubble and the 2008 financial crisis has made him wary of current market conditions that seem eerily similar. Buffett's concerns are not unfounded. Historical data supports his view that markets tend to revert to their mean, and periods of excessive valuation are often followed by significant downturns. His prudent approach serves as a reminder of the cyclical nature of markets. Several market indicators suggest that valuations are stretched. High price-to-earnings ratios, low dividend yields, and other metrics indicate that the market may be in a bubble. These signs are causing seasoned investors to exercise caution. These indicators provide a reality check for investors caught up in the market's momentum. It's easy to get swept away by bullish trends, but Buffett's warnings serve as a sobering reminder to stay grounded and make informed decisions. Ignoring these warning signs could lead to significant losses. Investors who fail to heed Buffett's advice may find themselves facing substantial financial setbacks when the market corrects itself. In this essay, we will delve into the reasons behind Buffett's concerns and explore potential investment strategies. By understanding his perspective, investors can better navigate the complexities of the market and make more informed choices to protect their investments. The Schiller PE ratio, also known as the CAPE ratio, is a measure of market valuation. It was developed by economist Robert Schiller and is used to assess whether a market is overvalued or undervalued by comparing current stock prices to their average earnings over the past 10 years, adjusted for inflation. This long-term perspective helps smooth out short-term volatility and provides a more stable view of market valuation. By looking at a decade's worth of earnings, the CAPE ratio aims to give a clearer picture of whether stock prices are justified by historical performance. Currently, the CAPE ratio is significantly above its historical average, which has raised concerns among investors and analysts. Historically, a high CAPE ratio has often been followed by lower-than-average returns in the stock market, suggesting that the market may be overpriced. This suggests that the market may be overpriced. When the CAPE ratio is elevated, it indicates that investors are paying more for stocks relative to their historical earnings, which could be a sign of overvaluation and potential market correction. Another indicator, the Fear and Greed Index, points towards excessive optimism in the market. This index, created by CNN Money, measures investor sentiment on a scale from extreme fear to extreme greed, based on various factors such as market volatility, stock price strength, and demand for safe haven assets. This index measures investor sentiment. When the index is high, it indicates that investors are greedy and may be overlooking risks. High levels of greed can lead to speculative bubbles where asset prices are driven up by irrational exuberance rather than fundamental value. When the index is high, it indicates that investors are greedy and may be overlooking risks. This can create a dangerous environment where prices are inflated beyond their true worth, increasing the likelihood of a market correction or crash. The EV/FCF ratio, which compares a company's enterprise value to its free cash flow, is also elevated for many companies. This ratio is important because it provides insight into how much investors are willing to pay for a company's cash flow, which is a key indicator of financial health and future growth potential. This suggests that investors are paying a premium for future growth that may not materialize. When the EV/FCF ratio is high, it indicates that investors have high expectations for a company's future performance, which may not be realistic. If these expectations are not met, it could lead to significant declines in stock prices. The current market conditions share similarities with previous bubbles. Throughout history, financial markets have experienced periods of excessive speculation, leading to dramatic rises and subsequent crashes. These cycles of boom and bust are often driven by a combination of investor psychology, economic factors, and technological advancements. In the late 1990s, the dot-com bubble inflated due to irrational exuberance for technology stocks. Investors were captivated by the potential of the internet and poured money into tech companies, many of which had no viable business models or profits. The promise of future growth and innovation led to a frenzy of investment. Investors poured money into companies with little to no earnings, driving valuations to unsustainable levels. Initial public offerings, IPOs of tech companies, were met with overwhelming demand, and stock prices soared to unprecedented heights. The market seemed unstoppable, and the fear of missing out drove even more investment. When the bubble burst, many investors faced substantial losses. Companies that had been valued in the billions became worthless overnight. The crash led to widespread financial distress, with many losing their life savings. The aftermath of the dot-com bubble served as a harsh reminder of the dangers of speculative investing. Similarly, the housing bubble in the mid-2000s was fueled by easy credit and speculative investing. Low interest rates and lax lending standards allowed many people to buy homes they couldn't afford. Real estate was seen as a surefire investment, and home prices began to rise rapidly. Home prices skyrocketed, leading to a subprime mortgage crisis. As more people defaulted on their loans, the housing market began to collapse. The ripple effects were felt throughout the financial system as mortgage-backed securities lost value and financial institutions faced significant losses. The collapse of the housing market triggered a global financial crisis. Banks and financial institutions around the world were affected, leading to a severe economic downturn. Governments had to step in with bailouts and stimulus packages to stabilize the economy and prevent a complete financial meltdown. These historical examples underscore the importance of recognizing market bubbles and managing risk. By understanding the factors that contribute to market excess, investors can make more informed decisions and avoid the pitfalls of speculative mania. It is crucial to remain vigilant and to approach investments with a balanced perspective, always considering the potential risks and rewards. The performance of different asset classes has been uneven in recent years. While the stock market has reached record highs, other asset classes, such as bonds, have generated modest returns. This disparity in returns is partly due to the low interest rate environment. Investors seeking higher returns have piled into stocks, driving up valuations. However, as interest rates rise, the attractiveness of bonds may increase. This could lead to a shift in capital flows, potentially impacting stock market returns. It is crucial for investors to diversify their portfolios across different asset classes to mitigate risk. Section 5. The Prudence of Cash, Warren Buffett's defensive strategy. Warren Buffett's Berkshire Hathaway, a multinational conglomerate, is currently holding a substantial amount of cash. This strategy reflects Buffett's cautious outlook on the market. Buffett views cash as a strategic asset that provides flexibility. In an overpriced market, finding attractive investment opportunities becomes challenging. Holding cash allows Buffett to seize opportunities when they arise, such as during market corrections. When others are fearful, Buffett is often a buyer. His patience and discipline have been key to his long-term success. Section 6. Looking beyond borders, international market opportunities. While the U.S. stock market appears expensive, international markets may offer more reasonable valuations. Emerging markets in particular have the potential for higher growth. Investing in international markets provides diversification benefits. However, investing in international markets also carries risks, such as currency fluctuations and political instability. It is important to conduct thorough research and consider consulting with a financial advisor before making any investment decisions. Section 7. Navigating the overpriced market strategies for investors. In an overpriced market, investors need to be selective and prioritize risk management. Diversifying across different asset classes, sectors, and geographies can help mitigate risk. Value investing, a strategy favored by Warren Buffett, involves seeking undervalued companies with strong fundamentals. Investors should also consider maintaining a cash reserve. This provides flexibility to invest during market downturns and take advantage of lower prices. It is essential to avoid emotional decision-making and to focus on long-term investment goals. Section 8. The importance of patience and discipline. Investing in the stock market requires patience and discipline. Market corrections are a normal part of the economic cycle. Trying to time the market is often futile and can lead to costly mistakes. Instead, investors should focus on a long-term investment horizon. By staying invested and riding out market fluctuations, investors can benefit from the power of compounding. It is important to remember that time in the market is more important than timing the market. Section 9. Conclusion: Balancing risk and reward. The current market environment presents both opportunities and risks. While market indices are at record highs, indicators suggest potential overvaluation. Warren Buffett's cautious approach highlights the importance of risk management. By diversifying, seeking value, and staying disciplined, investors can navigate the market and work towards their financial goals. Remember that investing always involves risk. It is essential to consult with a financial advisor to determine the best investment strategy based on your individual circumstances and risk tolerance.